Hello student, this is the fifth video in the topic of terms in accounting. Let's check out the terms that we will cover in this video. 24th term, trade receivables. 25th term, trade payables. 26th term, cost. 27th term, voucher. 28th term, discount. And 29th term, rebate. Let's check out 24th term, trade receivables. 24th term, trade receivables. This is the amount which is receivable for the sale of the goods or rendering of service. Trade receivables consists of debtors and bills receivable. Who's a debtor? A person who owes money to the business for the goods sold or services rendered. And what's a bills receivable? It is a bill of exchange accepted by a debtor, the amount of which will be received on a specified date. A bills receivable replaces a debtor. Now let's say the business sells goods rupees 50,000 on credit to Mr. A. So the transaction is a credit sale. So A has not paid the amount of rupees 50,000 immediately to the business. So Mr. A is considered as a debtor to the business, a person who owes money to the business for the goods sold or services rendered. Now, if the business so wants, it can ask the debtor, Mr. A, to accept a bill of exchange, promising to pay the amount of 50,000 on a specified date. Now, once Mr. A accepts the bill of exchange, the asset changes from debtor to bills receivable. That is, the bills receivable will replace the debtor. So, this is an example of trade receivables. The amount which is receivable for the sale of goods. Mr. A is considered a debtor to the business because he owes money to the business for the goods sold by the business. If A accepts a bill, then from the business point of view, it's a bills receivable which will replace Mr. A as a debtor. Twenty-fifth term, trade payables. This is the amount which is payable by the business for the purchase of goods or for services taken. Trade payables consists of creditors and bills payable. Who is a creditor? A person to whom the business owes money for the purchase of goods or services taken. What is a bills payable? A bill of exchange accepted by the business, the amount of which will be paid by the business on a specified date. A bills payable replaces a creditor. Now let's say the business purchases goods rupees 1 lakh from Mr. X on credit. Now this is a credit purchase. So the business does not pay the amount of the purchase, the rupees 1 lakh, to Mr. X immediately. So Mr. X is a creditor to the business, a person to whom the business owes money for the purchase of goods. So Mr. X is called a creditor. And if the business accepts a bill of exchange promising to pay the amount of rupees 1 lakh on a specified date, then the creditor of Mr. X is replaced by the liability called bills payable. A bills payable is a negotiable instrument, a bill of exchange wherein the business promises to pay a certain amount of money as on a specified date. So, trade payables is the amount which is payable by the business for the purchase of goods or services taken. Trade payables may be creditors or bills payable. A creditor is a person to whom the business owes money for the purchase of goods or services taken. A bills payable is a bill of exchange which is accepted by the business, the amount of which will be payable on a specified date. Twenty-sixth term, cost. Cost is the amount of expenditure which is incurred or attributable to any product, thing, activity or article. So whatever has gone in to make the particular product, thing, activity or article, that expenditure is referred to as cost. Twenty-seventh term, voucher. It is a document which evidences a transaction. Any document which evidences a transaction is referred to as voucher. Let's check out the examples of vouchers. For cash sales, a cash memo is a document which is issued and therefore it's a voucher. For credit purchases, a bill is issued. For credit sales, an invoice. For the receipt of cash, a receipt is raised. And for deposit of cash or checks in bank, pay-in slip is raised. And for purchase return, a debit note is raised. And for sales return, a credit note is raised. So all these are documents which evidences the transaction. A cash memo, bill, invoice, receipt, pay-in slip, debit note or credit note. Twenty-eighth term, discount. Discount is of two types. It may be a trade discount or a cash discount. Let's check out each of this. Trade discount. It is a discount which is allowed on the list price to encourage purchases. It is allowed by the seller on the basis of quantity sold or value. Trade discount is not recorded in the books of accounts. For example, discount allowed by the manufacturer to the wholesaler or the wholesaler to the retailer. On the other hand, a cash discount is discount which is offered for prompt payment of dues. Cash discount is recorded in the books of accounts. Now let's say A sells goods to B. Now if A gives a discount to B because B has purchased a bulk quantity of goods from A, then it is called trade discount. So for bulk purchases in quantity or value, for this the trade discount is given. On the other hand, if A gives a discount to B because B is paying the money within 3 days or 4 days or 1 week, then for prompt payment of dues, the discount which is given is called cash discount. So any discount which is given for bulk purchases in quantity and value, that is called trade discount, and trade discount is not recorded in the books. Any discount which is given because the buyer is going to make prompt payment of amount due, then that is called cash discount. Cash discount is recorded in the books of accounts. 29th term is rebate. It's the last term in this video. Rebate is the discount which is allowed by the seller to the purchaser for reasons other than for which trade discount and cash discount is allowed. So we already saw trade discount is given for bulk purchases in quantity and value, and cash discount is given for prompt payment of dues. Now, for other than these two reasons, if any discount is allowed by the seller to the purchaser, then it is referred to as rebate. To give you an example, rebate may be allowed for poor quality or defective quality of goods sold. So we've seen a few more terms in this video. We will see the remaining terms in the successive videos.